Welcome to our second presentation on charitable remainder trusts. Our last presentation explained the basic benefits of charitable remainder trusts, CRTs for short: lifetime income, an immediate charitable income tax deduction, the bypass of capital gains tax on the sale of appreciated property, and a gift to good causes. Now we're going to explore how some of these benefits are calculated. What I'm hoping you will remember, however, is not every detail, but the basic dynamics of how CRTs function. While the math may seem complicated, the underlying logic is easy to understand. I mentioned in the last section that donors who contribute something to a charitable remainder trust get an immediate charitable income tax deduction. Even though the good causes have received nothing, the IRS allows the deduction because the donor has entered into an irrevocable agreement right now, so you get your deduction right now. How do you figure out what that deduction is in your particular case? Basically, you ask 4 simple questions. How much was your gift worth to the good causes you've chosen on the date it was contributed to the trust? How long will the cause or causes you've chosen wait before they get anything? How hard is the trust working for its income beneficiaries? How well was the economy doing when you made the gift? Let's start with how much is the gift worth to charity the day you give it. Say you contribute $300,000 in cash to a charitable remainder trust. You probably would assume that your charitable deduction calculation would start with that $300,000 figure. You would be right. But you would also suspect that because the good causes you've chosen are unlikely to benefit from your gift for several years, you probably would not receive a full $300,000 charitable income tax deduction. Again, you would be right. As mentioned in the previous presentation, the IRS was not born yesterday. It can tell the difference between your handing over $300,000 to a good cause with no strings attached and your setting aside $300,000 in a CRT that will only pass to the good cause after you and all other income beneficiaries named in the trust no longer have any right to further income payments. To put it simply, what would you value more? $300,000 given to you right now, or $300,000 promised to you now, but delivered later, perhaps many years from now? The IRS thinks the same way. But at least we have a starting point, the full value of the gift at time of transfer to the trust. That's easy to determine with cash or publicly traded stock. You just add up the face value of the cash. Publicly traded stock is slightly, but only slightly, more complicated. You just calculate the average of the high and the low of the stock's value on the day of transfer. Real estate is more complicated. You will need an appraisal done by a qualified appraiser who is not involved in the sale of the property. The appraisal must not be older than 60 days before you transfer the real estate to your CRT. The IRS wants a reasonably fresh, qualified appraisal. However, they allow you to do it after the real estate is transferred to the trust, but not after you claim the amount as a charitable income tax deduction on your tax return. The appraisal must be done by the time you submit the tax return claiming the deduction. With a gift of real estate, the appraiser will fill out and sign IRS Form 8283 stating the value of the real estate at the time of transfer to your CRT. Let's return then to our simple $300,000 cash contribution to the CRT. You have your starting point for the deduction calculation. What do you do next? you find out how long the IRS will say the good cause has to wait. Yes, the IRS has a book of life that coldly determines your life expectancy and the life expectancies of anyone else you've named as an income beneficiary of your CRT. The actual physical condition of any of the CRT's income beneficiary is of no interest to the IRS. All they want to know are the birth dates of all income beneficiaries. Using that information, the IRS can estimate how long the good cause will have to wait. For example, let's say you're 70 years of age and that you are the sole income beneficiary of your CRT. The IRS gives you about 17 more years of life. Or put more delicately, the IRS says the good cause will have to wait about 17 years before it gets anything. It doesn't matter if you die well before or live well beyond the 17-year estimate. Your charitable income tax deduction remains unaffected. So, we have the worth of your gift the day you gave it, $300,000. We also have the estimate of how long the good cause will have to wait, 17 years. Are we ready to do your charitable income tax deduction? Not quite. The IRS wants to know how hard your CRT is going to work for you. Fortunately, that's very easy to determine. You just look at your CRT document and check the payment rate you've written into it. By law, your CRT must have at least a 5% payment rate. You can choose a higher rate if you wish, but the higher the rate, the less your deduction will be. And the logic of that is easy to understand. The more your CRT has to pay you during life, the less it will have to pay the charities upon your death. Let's say you choose the minimum 5% payment rate and write it into your irrevocable charitable remainder trust. You are almost ready to do that elusive calculation. What's left to do? You've got to plug in how well the economy is doing. How in the world do you do that? It's easy. Every month, the IRS publishes something called the applicable federal rate as a measure of how the economy is doing based on interest rates. The higher the applicable federal rate, the higher your deduction. The IRS allows you to choose the rate for the month you make your gift or the rates for the prior 2 months. If you want the highest possible deduction, you choose the highest applicable federal rate of those 3 months. Though this may seem a bit confusing, the underlying principle is simple. The better the economy is doing, the more the charity is likely to get and the more valuable your gift. So you have almost everything you need for the income tax calculation. I say you have almost because you need to include how often you get CRT payments, monthly, quarterly, semi-annual, or annual. The more frequent your payments, the less your charitable deduction. Let's say you select quarterly payments, a very common choice. Finally, we're ready to calculate the charitable income tax deduction triggered by a $300,000 gift to a 5% charitable remainder unit trust, which will pay you, now 70 years of age, quarterly payments for the rest of your life. And the deduction is about $157,000. About? How can I say about after putting you through all of this? Because by the time you get around to doing this, interest rates may be going through the roof, and the economy may be much more vigorous, or not. You may have a much higher applicable federal rate to deal with, or not. A higher rate will give you a larger charitable income tax deduction. A lower rate will give you a lower charitable income tax deduction. so our $157,000 tax deduction is only an estimate. Many charities, including the sponsor of these presentations, can run the calculation estimate for you. Just call them and tell them the kind of contribution you're considering, cash, stock, or real estate, for example, the current value of the gift, the birth dates of all the income beneficiaries you plan to name, and the payment rate of the trust. The charity will look up the applicable federal rate and, unless you object, assume a current gift date and choose the most favorable applicable federal rate it can. Then take the numbers provided you by the charity and present them to your financial and estate planning advisors for their review and advice. Whatever numbers the good causes give you are a rough estimate and for educational purposes only. You need independent professional counsel before making a decision. You also need more information on the details of CRTs. Using 3 examples, I'll illustrate variations on the CRT theme in the next presentation. I hope you'll join me in Doing Well While Doing Good, Part 3, Examples of Tailor-Made CRTs. See you then.